So we are now going to talk, or we've already talked a bit about data, but we're going to continue discussion on ESG data. We have Sarah Labbé, who's from Les Acteurs de la Finance Responsable, and we have Petra Besson-Fencikova, I can never say your name. Fencikova, voilà. Head of ESG investments at Société Générale. And they're going to be looking at, okay, how can we look at streamlining our data and looking at our performance requirements. And what do you, the clicker, you want the clicker. So I let you go. Off you go with your 30 minutes.
Okay, thank you so much. Good afternoon, everyone. Hello, Petra. Happy to be here today. I'm going to just test the clicker. Yes, everything is working. It's perfect. So yeah, my name is Sarah Labbé. I'm the co-founder of an association named Les Acteurs de la Finance Responsable. And today I'm joined by Petra Besson-Fencikova, Head of ESG Investment at Société Générale's Wealth Management. You bring over 10 years of experience in portfolio management, and we will spend the next 30 minutes discussing, let's say, the current state of sustainable investment, explore the slowdown of the market, of course, how data and regulation are evolving, and which tool will shape the ESG of tomorrow. Let's begin. Here we are. So yeah, let's begin with the first slide to introduce my first question to you. So here is a chart from our colleague at Morningstar Sustainalytics. And what you can see in the screen is the evolution of sustainable versus conventional fund flows over the past 3 years. So after, as you know, several years of expansion, growth has become weaker, if I can say that. In some quarters, almost flat. And finally, until the low point on the first quarter of this year, we can see the first recorded and unique recorded negative quarter net flows. So in contrast with this first information, we see that conventional fund segment has shown a strong growth since last year. So my feeling is that this slowdown doesn't really mean that investors have completely lost interest in ESG. I don't think so, but it definitely reflects a more difficult environment marked by market uncertainty, by geopolitical tension, new energy and defense priorities also. So I'll say that, in other words, it's not the end of ESG, of course, but it's a period of readjustment where the market moves from, let's say, enthusiasm to maturity, probably. And my first question to you, Petra, will be that you speak with clients and investors every day. So what do you think? Does this reflect a real ESG fatigue, or is it more like a reaction to the noise we see in the media and the political debate?
Yeah, thank you, Sarah, for the question. Hello, everybody. So I'm going to talk on behalf of my perspective as a portfolio manager and ESG specialist. And yeah, when we started 10 years ago doing ESG investing, everybody was saying a little bit it was something nice to have. We continue to do it by the conviction that it's material for the investments and that it helps us to have better confidence in our business cases. And that's something that even all this ESG backlash we have, more and more investors are realizing. And with the ESG backlash that is so much in the media, finally, the people are questioning. But when we are doing several surveys, not us, but the other financial actors, they did several surveys. They found out that the engagements towards ESG integration, the engagements towards following the net zero policies, they remain or even becoming much stronger. So in the asset managers, It was the survey from BNP. 87% of institutionals from more than 400 studies said that the ESG goals remained and were unchanged. And even today, it came out the study from BlackRock who studied the insurers. And in the insurance space, it's even more tangible. There is a much stronger ESG commitments and much more stronger ESG integration that it used to be. So probably it's not the ESG fatigue, too much ESG backlash coming from across Atlantic, and more maturity, of course, with all the regulation coming in the Europe.
Thank you so much. It actually connects well with to the regulatory side, I think. Maybe we can continue and take a quick step back regarding CSRD, Omnibus. There is a huge topic here because it's for almost 10 years, we had the chance, thanks to NFRD, to have around 12,000 companies reporting. All of them had more than 500, it's an important figure, employees, and they had to produce some sustainability report, really useful for investors. And with the introduction of CSRD, the European Commission wanted to extend to a much broader part of the economy, this reporting. So it was then designed to cover close to 50,000 companies, wow, by 2028, including, of course, a lot of small and middle caps. And then finally, even if we were sure that it will create a more consistent and comparable base of data for sustainability, we had the announcement of Omnibus proposal. It completely changed the picture, finally, because the message is that our regulation was too complex, that it was hard to present to the corporate, and this simplification package, so aim to, as I say, reduce the administrative burden. And finally, among other things, it suggests to rise the employee threshold to 1,000 this time. It will simplify the taxonomy reporting. It will reduce the impact of the due diligence directive, by the way. And it means, finally, that it will dramatically reduce the number of companies required to publish sustainable information. And, of course, from investor perspective, it means a lot of things. It means that it will reduce the reported data point available for us. It means that we will need to use more estimates. Also that it will be more difficult to compare some portfolios. And of course, it risks to create new data gaps, to generate less transparency and more challenges to fulfill regulatory requirements like SFDR or label requirements, for example. So yeah, Petra, from a company perspective, of course, this proposal sounds reasonable, no doubt. But from the point of view of investors, what do you think? It can raise, from my point of view, it can raise real concern about the data quality. So how do you see this shift, finally?
Yeah, indeed. So it depends what you invest in. If you're a large cap investor, you will have the data on European corporates. But as soon as you are going global to the mid caps, for example, in stock 600, so 600 largest corporations in Europe, there are around 100 companies that will not be subject to CSRD. So going to the lower revenue threshold and lower number of employees, you will not have anymore the same data quality. So inconvenient for us as investors, we will need to go back to the estimates of the data providers, so more business for those data providers. But maybe there is the use of those space data that could help us to standardize. So I will definitely have a look at it. The people that were talking on the previous panel, and what will need to do, what is a little inconvenient of this is that we cannot compare the things across companies. But then we have the other tool, it's the engagement. So we still can go and discuss with the company. They will have they can apply the voluntary standards that were recommended by European Commission, and that is something more simpler and easier to put in place for those companies. So hopefully we will have at least those voluntary standard data that will help us to have the homogeneous reporting across our investments.
Thank you so much. And yeah, definitely fewer companies end up disclosing, no doubt. Investor will have to rely again on estimates. But in fact, I would love to show you this chart because, in fact, a large part of the data we already use as investors are from estimation model coming from our data providers. That's true. This estimate can be extremely useful for different reasons, to fill data gaps, to ensure market coverage also. But they can also raise questions regarding data quality, regarding consistency sometimes. And I think that carbon emissions are an excellent example. As shown in this chart from our colleague at MSCI this time, the proportion of listed company reporting for Scope 1 and 2 has risen a lot in the past few years, but remain finally below 80% of the listed markets. For Scope 3, disclosure has also improved, I can say that, but still covers only half of the listed issuers and only for some specific category, not necessarily all of them. So this means that a significant part of total emission data remain completely estimates rather than reporting. And of course, the challenge goes beyond only carbon emission, but applies to a wide range of ESG and climate data at the end. So yeah, Petra, my next question will be, how do you deal with this practice? How do you ensure your team, your client, can keep confidence in the data while recognizing its limitation? Because there is. How do you deal with that?
Yeah, indeed. And once we have the data reported, it doesn't mean that the companies have used the same methodology across the region, across the countries, across the sectors. So we do have really huge disparities in this. And on Scope 1 and 2, the companies were reporting since some time, so they have standardized the methodology. But on Scope 3, for example, you still not have enough of the whole scope reported, and the methodologies differ really a lot. So at the end, we need to rely on the estimates as for now. And what is very important is that you are using the same source and the same methodology across all the assets, because otherwise you can sum the apples and pears, and it's not correct. Methodology, transparency, coherence across the asset classes, and disclosure that of all the discrepancies of the models that you can have, that the real emissions can really differ a lot compared to the real ones.
Thank you so much. Okay, let's now maybe have a look at the evolution of the European fund landscape. We spent some time together talking about this one. It's really, really interesting. First, as you can see on the left, normally on the right for you, on the right-hand chart, there was a sharp rise in the renaming activity this year, definitely. According to Sustainalytics, more than 600 funds changed their name in the second quarter alone. So it's really huge, definitely. This change aligns, of course, with the entry into force of the ESMA fund naming guidelines, which required funds using sustainability or ESG term to meet minimum standards, minimum exclusion. So that's the reason why probably there is a lot of changes in the name. The market is definitely cleaning up its terminology. And I think that rather than a wave of greenwashing, I think it signals an effort made by the asset manager and the market to align with clearer definition, and it was really useful at the end because we are starting to really be clear about what is ESG, what is sustainability, what does it mean net zero, and it was really necessary. And at the same time, if you take a look to the other chart on the screen, you can see that the total asset of Article 8 and 9 didn't move a lot. It stabilized around its 6.4, something like that, trillion euro, representing 60% of the market. And it didn't move a lot. So it means that despite the changes in the name, ESG strategies, reporting, transparency efforts remain the same, I think so. And Petra, I would like to have your point of view on these charts. How do you interpret this information? Again, is it like ESG, completely ESG fatigue, confusion, or finally maybe more maturity?
Yeah, more maturity, and banking financial institutions a lot afraid of greenwashing accusations, so that's why they are dropping the ESG terms. And maybe, and on the first chart, maybe there is more understanding that SFDR is more a disclosure regulation, and that all the ESG data, they are becoming so much available and so much needed by especially the institutional investors, that when you disclose yourself as Article 8 or 9, you need to disclose those data. So that is, it's not really the labeling for now. Maybe the new revision of the SFDR will be more about the labels, but it's the disclosure regulations. And what we see is that it's important when we have this disclosure regulation, if we want to go a step further, it's important to have the label. So thank you, looks like, for being here, because the label behind, it helps you it's like your audit. It's someone that verifies that you are doing what you are saying that you are doing. Of course, the regulator is also here, but how many of you have had the audit on the SFDR? So for now, it's the labels, they have their sense, and they are going a bit further than Article 8 or Article 9 classification. So yeah, we will see with the new revision of the SFDR. Maybe it will help us to classify more about the ESG.
Can't wait. Thank you so much. Maybe we can continue now because it's not exactly yeah,
it was much nicer.
Much nicer, definitely. Anyway, so yeah, our conversation about fund naming naturally connects to another regulation that you know very, very well, I can imagine. It's MiFID II. Under MiFID, investment distributor and advisor are required to access each client's sustainability preferences before recommending a product. In practice, it means asking whether the client wants their portfolio to integrate one or several of three criteria. The first one is taxonomy alignment, the second one PAIs, and the third one, sustainable investment definition in the sense of SFDR 2.17. So, in fact, for this sustainable investment definition, it means investment that make three things: positive contribution to environmental or social objective, do not significantly harm other objectives, and finally have a good governance practices, if you can say that. In theory, that was an excellent idea. This framework is designed to bring more transparency and consistency to client choices, so it has to be helpful. But in fact, each investor has its own definition of sustainability and sustainable investment, and they are quite complex, we can say that, I think. So Petra, how do you approach this in practice? How do you make this three dimension easily understandable for the client, and how do you present your own sustainable investment definition?
Huge challenge. Huge challenge, because even for myself, it's sometimes I meet the clients and we are doing those ESG questionnaires, and it's really complicated to explain to the private banking clients about what is the difference between environmental sustainable investments, sustainable activity, and sustainable investments. It looks like two questions, but if you answer on the taxonomy regulations, that of course I want renewable energies and everything aligned with taxonomy, and you say 90% of your investments, that means that you are taking a huge biases, sectoral biases on your investment portfolio. And what is then the difference with the sustainable investment? That this is something responding to the sustainable development goals. It's really not very easy to explain, even for the specialists. And there was some study with the mystery shopping people going and asking the banks about the financial products, and they found out that 22% of the advisors didn't ask those questions in Europe because I think they didn't have the training. And when the people said that they had a sustainable preferences, half of them didn't get the sustainable product they were aspiring for because those questions were not so well penetrated. So what we are trying to do, it's all about the trainings also within your organization, that we needed to train portfolio managers, investment advisors, private bankers, and we're trying to make it the more realistic to explain well what is sustainable investment and all those regulation. And we propose also we have the personalized approach, or the client can trust its private bank and choose the private banking approach that is doing some sustainable investments in a reasonable way, some taxonomy alignment, and taking into account some principal adverse impacts. So yeah, that's our way, and it's not the easy way.
And you're doing your best, and we can understand that things will evolve by the way. So we'll see. Okay, let's now continue with something else linked to sustainability preferences, because of course, thanks to MiFID, they are more visible in the client dialogue. But however, this is also brings us to, let's say, a key tension between perception of the market and performance. While many investors, I think, express an interest in sustainability in the past few years, their investment decision can still be influenced by their perception of the financial performance of the sustainable funds. And this chart from MSCI this time challenged that idea. It compared the performance of several ESG and SRI indexes with the global equity benchmark MSCI ACWI that you can see in blue. And what is super interesting is that we can see that all ESG indexes have performed better than the MSCI ACWI. And more importantly, this was achieved with the same level of volatility. So, meaning that stronger results does not mean taking more risk. So basically, it's just a better financial performance. This really tells us something important, is that sustainability is not just about value, just about reputation. It means that it's about identifying companies that manage their risk and their resources more effectively. And of course, Petra, my question here is, from your experience managing portfolio, do you observe this link, first of all, between sustainability and performance? When, how, and then how do you explain to your client, to the other portfolio manager, that ESG analysis can be like a risk management tool rather than a constraint on returns?
Yeah, I would say risk and opportunity management
again
tool.
And again.
So we are doing ESG integration because we believe that it's a material for the companies, and it helps us to have better confidence in our business cases. So the most general ESG integration is the risk avoidance. Yeah, you avoid the controversies, the stranded assets. But on the other side, it helps also the company to improve its operational efficiency. Of course, the good ESG integration on the social impacts, you have less turnover of the companies, you have higher productivity, higher innovation, better supply chain management. And on the environmental side, if you measure, you can reduce your costs due to environmental data. And then there are the other studies that are also showing that the good ESG companies, they have a lower cost of capital, and that they are more resistant in the times of volatility. They are less volatile in the stressed markets. So that's all the things that we are doing. We are integrating, and sometimes, especially this year, we are sometimes hearing that the ESG is not working. But we should separate the ESG and the thematic funds. There are some thematics that doesn't work, and sometimes there are thematics that doesn't have to be in the ESG space, and they don't work either. So let's just separate ESG and thematic. And when we have the ESG strategies, I must say that our portfolio managers, they very quickly understood it, and we have several strategies that are among the top 10 funds rated in the 5-star Morningstar funds. So we are firmly convinced that it does work and it does make sense. And there are other charts that are showing it.
Definitely. Thank you, Petra. Before we wrap up, I'd like to close with 2 other questions. The first one will be, here we are. The first one will be, could you suggest one priority measure to regulator to strike the right balance between simplification and data reliability? And what would it be in that case? Yeah. Hard question.
Yeah, hard question. So maybe one thing would be the standardization of the information. So there was some study that about CSRD reports that the average CSRD report is around 120 pages. So it's pretty complicated to read it, and even with the data providers, so we need them because they are extracting those information. They are the errors, and we are very often getting back to our data providers about are you sure of this figure? Why that? There are changes in the methodology. So it would be the data standardization. And on the other side, we are hearing about the revision of the regulation. And I would say that this time it would be really good if it was in a good timing, because the last time we had firstly SFDR, then we had MiFID, and then we have the CSRD. So it would be good.
And the taxonomy.
And taxonomy, so to make it in a good order this time.
Excellent idea. Fantastic. And then my second and last question, looking ahead, which skill or technology, of course, do you believe will be essential for future portfolio manager to succeed in ESG?
Yeah, so we are a lot talking about the AI, and I think that with so much data information, the good ESG portfolio manager will be very strong in data scientists using the AI to be augmented portfolio manager, and he will still need to have the critical spirit. It's not that AI will be doing on his behalf, but that he will have the critical spirit to analyze all those information that is more streamlined thanks to the AI.
Fantastic. Thank you so much. We have 2 minutes left maybe for questions, but thank you first of all.
Thank you.
Thanks, Sarah.
Do we have a minute for a question for Petra?
Thank you very much. Does anybody have any questions? Come on. No? Everybody's desperate for a coffee. You're both going to be here over coffee, so anybody who's not brave enough to ask now, they can catch up with you over coffee, I guess.
Okay.
Thank you very much.
Thank you so much. Have a good afternoon.
Thank you.